So let me give you the question we just posed to our previous guest. Do you buy this rally? And I know you're not sort of a day trader, but the rally that we've seen, if it goes into the end of the year, is that something you want to be a part of?
Look, we believe investors should stay invested, and the market is very strong, and we continue to have an outlook that's very favorable for the economy, the global economy. So being long equities is the right thing. You have to be a lot more careful today because valuations are pretty pricey. But we do think there are opportunities in equities to exploit.
Where are those opportunities, Seth? Good morning, it's Guy in London. Where are those opportunities? How do you see risk reward in the market more broadly?
Look, I think indices, particularly growth indices, are really out of balance, just given the top 10 names continue to be disproportionate in the returns and attraction they've had for investors. So we think there are real valuation opportunities away from them. We think that in fixed income, it's a tougher place, Guy, to find opportunity, just given our own outlook that inflation, most of it is transitory, but ultimately, if 10-year rates top out at 2.5, 2.75, even 3 briefly, with rising inflation, that is a real challenge for most investors. So we think people should be opportunistic. We try to have people invest and have the flexibility to bend against the wind, utilizing global high yield, emerging markets, but also treasuries in a more of a barbell approach.
So to that point, there's been talk about the 60-40 portfolio. It's going to turn this year. It's not going to help you. It's going to wind up hurting you. And a growing chorus of fund managers are looking at, say, alternative assets to supplement that 40 part of the portfolio. How does that factor into your strategy?
Well, 2 things. First, a 60-40 portfolio can't arithmetically generate the kind of returns it has historically, just by virtue of where overall interest rates are. And frankly, demand for government bonds should be more muted over time as a function of the fact that you need less bonds in your portfolio and a longer duration to accomplish the same degree of diversification. So if you're not getting income from them, you need to find alternative sources. And the fastest growth and income, of course, has been the factor, I think, that's been most hotly bid up in the marketplace generally. So you have to be very careful on how you find that income. Alternatives have been viewed by the market as the place to be, but frankly, very few alternatives really provide that kind of diversification. You are really betting on active management, and there's not that many great managers out there who are going to be able to not have a lot of directional market risk and generate predictable returns. So I think people are going to continue to need bonds in their portfolio. They will continue to up the yield on those bonds by using privates and high yield to generate more income, but they're going to be more volatile. It's going to be a much more volatile ride than it has been in prior years.
Seth, how does that affect your strategy then? Are you looking to bulk up in alternatives? Is that a space you want to expand in? I get a sense of caution from you when you talk about them, so I'm curious as to kind of where you're taking the business next.
Look, I believe private credit is still in the early stages of its development. It's very fast growing. Banks are challenged to retain these assets. There is a lot of money in motion, but pricing already sees a lot of that. I mean, we're already seeing much tighter spreads, looser covenants. So there's a lot of supply, but there's much more demand. And I think that will continue for a while. We continue to focus there. We have about $22 billion in private alts now, and we'd like to continue building that, particularly in credit. We look at infrastructure, we look at asset backs, we look at particular areas within it. So it's a very important part of our strategy, but we are not abandoning liquid markets. We continue to think there are really talented management teams out there who need a place that values active management and will give them the opportunity to grow faster than they could otherwise on their own. Well, so we see opportunities for ourselves both in alts as well as in traditional.
So just one more quick on this one, Seth. So you mentioned that you are looking in certain areas. What are prices like for those alternative assets that you might want to buy? There's been a lot of activity in the space.
Look, they've been really high. And so in our way of thinking, we'd rather buy them small. And if we're going to pay a market multiple for them, we'd rather buy them small and gain that growth for our clients and investors. So we tend to look at smaller opportunities, but you're absolutely right. The multiples are very high.
Seth, one of the other big trends, obviously, this year that has really sort of taken off is ESG. How do you rate the E, the S, and the G? Is there a worry that there is a bubble forming, particularly in the E? How do you invest in it, and how are you thinking about your strategy going forward?
Look, I think a lot of people have done very well, particularly investing in the E, because frankly, it correlates with growth stocks. Look, the more asset light you are, the smaller your footprint tends to be. Carbon footprint tends to be. So there may be bubbles in it, but what our view is that this is not a flash in the pan. It's real. Younger people care deeply about the environment, and we as stewards of that capital need to be more proactive in how we manage our portfolios. We have entered into a partnership with Columbia University in their climate school, and we've developed a curriculum which we put all of our investors through to make them much better informed, and we've built a dedicated team of research analysts who focus on broader climate issues, and we have a research agenda with Columbia in terms of thinking through that and applying it to how we're managing portfolios. But there will be bubbles periodically, as there are in all liquid markets.
Hey, Seth, before we let you go, in a word, what's your biggest worry for 2022?
I think the pandemic and geopolitical risk, as your prior guest was alluding to. I think we are in a much more volatile time. The United States was in a Goldilocks period after '89. We're now in a multipolar world, and it's much less predictable. And we don't know what new variants of COVID are going to portend for us to continue to reopen the economy.